Comex has 42 million ounces of registered silver available for delivery. That's the official number. Delivery requests are averaging 331,000 ounces per day. That's also official. Simple division, 42 million, divided by 331,000 equals 127 trading days. That's when registered inventory hits zero at current demand rates. This isn't prediction. This isn't speculation. This is arithmetic. And the countdown is public, verifiable, and accelerating. Every trading day that number decreases. The market can see it. The exchange can see it. And when countdown clocks become visible, behavior changes long before the deadline arrives. Let me explain what registered inventory actually means and why it matters so much. Comex warehouses hold two categories of silver, eligible and registered. Eligible silver is stored in approved warehouses, but not available for delivery against futures contracts. It's privately owned metal that happens to be in the system. Registered silver is metal that has been specifically designated as deliverable against contracts. Only registered silver counts for settlement purposes. The distinction is critical. When someone demands delivery on a futures contract, the exchange must provide registered silver. Eligible silver cannot be used unless the owner chooses to convert it to registered status. That conversion is voluntary and happens only when owners are willing to make their metal available. In normal times, there's enough registered inventory to meet delivery demand with plenty of buffer. We're no longer in normal times. Current registered inventory stands at 42 million ounces. That sounds like a large number until you compare it to open interest. Open interest represents the total number of outstanding futures contracts. Each contract represents 5,000 ounces. When open interest is high relative to registered inventory, it means the number of claims on silver far exceeds the amount of silver available to settle those claims. We're currently at a ratio where paper claims exceed registered inventory by significant multiples. This is where the math becomes uncomfortable. Delivery requests have been averaging 331,000 ounces per day over the past 30 trading days. That's not an anomaly or a spike. It's a consistent rate maintained across weeks. At that pace, registered inventory depletes in 127 trading days, not years, not months in the distant future. 127 trading days, which is roughly 6 calendar months. The countdown is precise enough that you can mark it on a calendar. If current trends continue, registered inventory reaches zero sometime in late June or early July. That's the deadline. That's when the exchange either has no metal left to deliver or must take extraordinary measures to source supply. And the market has 6 months to process what that means. Now let me address the obvious objection. Why assume the current rate of delivery requests continues? Maybe demand will fall. Maybe more eligible inventory will convert to registered. Maybe new supply will arrive. All of those are possibilities, but they require specific events or behavior changes that are not guaranteed. What is guaranteed is that if the current rate persists, inventory depletes by a calculable date. That's the baseline scenario, and it's uncomfortable enough that it deserves serious attention. Here's why the current delivery rate might not just persist, but accelerate. When participants start to worry that inventory is running low, they have incentive to demand delivery sooner rather than later. Nobody wants to be last in line when supplies are dwindling. That psychology creates front-running behavior where the fear of shortage drives earlier delivery requests, which accelerates the depletion, which increases fear, which drives more delivery requests. It's a self-reinforcing loop. This dynamic has historical precedent. During previous periods when registered inventory fell to uncomfortable levels, delivery requests surged as participants scrambled to secure metal before it was gone. The result was inventory drawdowns that happened faster than linear projections suggested. If that pattern repeats, 127 days might be optimistic. The actual timeline could be shorter. Let me walk through what happens as inventory approaches critically low levels. First, the exchange becomes increasingly nervous about its ability to fulfill delivery obligations. That nervousness manifests in several ways. Margin requirements might be raised to discourage position taking. Delivery procedures might be tightened to slow the rate of requests. Communication from the exchange might emphasize the availability of eligible inventory and the expectation that it will convert as needed. Second, market participants start pricing in delivery risk. If there's a meaningful probability that contracts won't be deliverable at maturity, that risk shows up in basis spreads and roll costs. Near-term contracts might trade at premiums to deferred contracts as buyers pay up to secure delivery dates before inventory runs out. That inversion of normal futures curve structure is a signal that the market is pricing scarcity. Third, arbitrage between Comex and physical markets breaks down. If participants doubt that Comex contracts are convertible to physical metal, they stop treating Comex prices as authoritative. Physical premiums widen, regional markets decouple, the unified global pricing mechanism fractures. And once that fracturing becomes visible, confidence in paper markets erodes rapidly. Fourth, regulatory and exchange interventions become likely. Exchanges have several tools to manage delivery crises. They can change contract specifications, they can implement position limits, they can restrict delivery to certain categories of participants, they can even force cash settlement in extreme cases. All of these measures are designed to prevent the exchange from literally running out of metal, but all of them also damage credibility and signal that the system is under stress. The question is not whether interventions will happen. The question is when and how aggressive they'll be. If inventory depletion continues at the current pace, interventions become necessary well before the 127-day deadline. Exchanges don't wait until inventory hits zero. They act preemptively when inventory falls below levels they consider safe. That threshold is not public, but it's likely higher than zero. This is where the countdown becomes psychologically important. Once participants internalize that there's a specific timeline, their behavior changes. Traders who were planning to hold contracts through expiry might decide to close positions early. Industrial users who rely on Comex for hedging might shift to physical markets or long-term supply contracts. Investors who thought they had exposure to silver through futures might realize they're actually exposed to the exchange's ability to source metal. All of those behavior changes feed back into the dynamics. Early position closing reduces open interest, which might temporarily relieve pressure. But it also reveals that confidence is eroding. Shifts to physical markets increase demand for actual metal, which tightens the physical supply that Comex might need to tap. And realization that contracts might not be deliverable accelerates the very delivery requests the exchange fears. Let me be clear about what this timeline does not mean. It does not mean the silver market will collapse in 127 days. It does not mean Comex will default on contracts. It does not mean prices will explode overnight. What it means is that the current structure of the paper silver market is under measurable stress that will force adjustments. Those adjustments might be smooth or they might be chaotic, but they will happen. The cleanest adjustment would be a significant increase in registered inventory. If large holders of eligible silver decide to convert to registered status, the available pool increases and the countdown resets. This is what the exchange is hoping for. The problem is that conversion is voluntary. Holders of eligible silver have chosen not to make it available for delivery. Convincing them to change that decision requires either much higher prices or changes to contract terms that make delivery more attractive to them. Higher prices might work, but there's a threshold question. How much higher do prices need to go before enough eligible silver converts to relieve the pressure? If the answer is 10 or 20%, that's manageable. If the answer is 50 or 70%, that's a different scenario. And nobody knows the answer because the willingness of eligible holders to convert depends on their individual calculations of value, opportunity cost, and risk. Changes to contract terms are possible but problematic. The exchange could offer incentives for conversion, such as reduced storage fees or preferential treatment in delivery queues. But any changes to contract terms during a delivery crisis raise questions about whether the contracts mean what participants thought they meant. That damages trust, even if the changes are technically legal and procedurally proper. Another possible adjustment is a collapse in delivery requests. If participants become convinced that Comex will find ways to source metal or that prices will fall, they might decide not to take delivery. This is what happened in previous periods of stress. Delivery demand surged, threatened inventory levels, then subsided as the exchange took actions to reassure the market. The cycle repeated multiple times without triggering a full crisis. The difference this time is visibility. Previous episodes were less transparent. Data on registered inventory and delivery requests was less widely disseminated. Participants had less ability to track the countdown in real time. Today, the numbers are public, updated daily, and easily accessible. That transparency makes it harder for the exchange to manage expectations through selective communication. The math is visible to everyone. Here's the scenario that worries market observers most. Delivery requests continue at the current pace or accelerate. Registered inventory falls below levels the exchange considers safe. The exchange implements emergency measures, higher margins, position limits, changes to delivery procedures. Those measures are interpreted as confirmation that the situation is serious. That interpretation drives more delivery requests from participants who want to secure metal before restrictions tighten. The loop accelerates. Inventory depletes faster than projected. The exchange is forced into increasingly aggressive interventions. Confidence collapses. That scenario is not inevitable, but it's plausible. And plausibility is enough to change behavior. Traders managing risk don't wait for worst-case scenarios to materialize. They position based on the probability of those scenarios. When a countdown becomes visible and calculable, even a modest probability of crisis justifies adjustments to positioning. And those adjustments in aggregate can create the very crisis they were intended to avoid. This is the paradox of transparent countdowns. They provide clarity, which is normally valuable, but they also provide coordination points for fear. When everyone can see the same deadline approaching, panics can synchronize. Instead of gradual adjustment spread over time, You get concentrated reactions as participants front-run each other's attempts to front-run the deadline. Let me walk through the institutional perspective, because institutions are the ones with the most at stake. Large banks and trading firms use Comex silver contracts for hedging commercial positions, managing client exposure, and proprietary trading. Those strategies all assume that contracts are convertible to physical metal at predictable costs. If that assumption breaks, the entire edifice of financial engineering built on top of these contracts becomes suspect. Institutions managing client money face fiduciary obligations. If there's a material risk that silver contracts won't be deliverable, they need to disclose that risk or adjust positioning. That adjustment often means reducing exposure or moving to physical markets where delivery is certain. The problem is that moving large positions takes time and creates market impact. You can't exit a billion-dollar derivatives position overnight without moving prices or alerting the market to your intent. This creates a coordination problem. No institution wants to be the first to publicly question Comex deliverability, because doing so might trigger the panic they're trying to avoid. But no institution wants to be the last one holding contracts when deliverability becomes an issue. The result is quiet, gradual repositioning that might accelerate suddenly if a trigger event provides cover for more aggressive action. Industrial users face a different calculus. Companies that use silver in manufacturing rely on Comex for price hedging. They sell futures to lock in costs and secure predictable input pricing. If Comex contracts become unreliable, those hedges break. Suddenly, a tool designed to reduce risk becomes a source of risk. That realization drives companies to secure physical supply through long-term contracts with producers or stockpiling. Both responses tighten physical markets while reducing reliance on Comex. Investors are perhaps the most exposed because many don't realize they're exposed to delivery risk at all. Silver ETFs that claim to hold physical metal are generally more secure because they've already taken delivery. But ETFs that use futures or derivatives to create synthetic exposure are directly affected by Comex deliverability. If contracts settle in cash instead of metal, investors get dollars instead of ounces. That might be fine for speculators, but defeats the purpose for those holding silver as an inflation hedge or store of value. The countdown forces all of these participants to confront questions they'd prefer to ignore. Can Comex actually deliver on all outstanding contracts if everyone demands metal simultaneously? Has the growth of paper claims outpaced the availability of physical supply? Is the futures market still a legitimate price discovery mechanism, or has it become a financial abstraction disconnected from the physical commodity? These are not comfortable questions for an exchange or a market to face, but they're becoming unavoidable. 127 trading days is not a distant abstraction. It's 6 months. Companies budget quarterly. Investors review portfolios monthly. Traders manage risk daily. On all of those time frames, 6 months is close enough to matter. Here's what makes this particularly challenging for the exchange. They can't publicly acknowledge that inventory depletion is a serious concern without validating the fears that drive delivery requests. But they can't ignore it either because the math is public and market participants are already tracking it. The result is likely to be carefully worded statements emphasizing market resilience and available supply while quietly taking actions to slow delivery rates or encourage inventory conversion. Those actions might succeed in extending the timeline. Margins could be raised enough to discourage speculative longs from demanding delivery. Incentives could be structured to make conversion attractive to eligible holders. Communication could emphasize the depth of physical markets outside Comex. All of that might reset the countdown and ease pressure. But every intervention also chips away at the perception that Comex is a neutral, market-driven venue. Each rule change looks like the exchange favoring sellers over buyers or financial participants over physical demanders. That perception erodes confidence. And in markets, confidence is everything. Once participants start questioning whether contracts will be honored as written, the contracts lose value regardless of official assurances. This is why the countdown matters more than the specific number. 127 days might stretch to 200 if delivery rates slow. It might shrink to 70 if rates accelerate. The exact timing is less important than the fact that there is a timeline, it's calculable, it's public, and it's getting shorter. That visibility changes everything. For market observers, the countdown is a stress test in slow motion. We're watching in real time whether a major commodity exchange can manage delivery obligations when physical demand exceeds immediately available supply. The outcome will set precedents for how similar situations are handled in the future. It will determine how much trust participants place in paper markets versus physical, and it will reveal whether the financialization of commodities has reached a point where paper claims can no longer be credibly backed by physical assets. The arithmetic is simple. The implications are not. 42 million ounces divided by 331,000 ounces per day equals 127 days. That's the math. What happens during those 127 days will determine whether that math results in a routine adjustment or a structural crisis. The clock is running. The market is watching. And the number decreases every trading day.